Good morning and evening, ladies and gentlemen. Today we're going to be talking about the market and the week that we just had in this crazy up and down market, or really the up market. But we're going to be going over the bull scenario, the bear scenario, and where I see the market going. So let's get started with the bull scenario. You had accumulation building up at the 370 and 380 level, which we then exploded out of, destroying anyone that was short, squeezing them out. And now we're basically climbing the stairs of worry, as they call it. So you have go up, come down a little bit, go up, come down a little bit, go up, open down, and then keep pushing up. So we're in an uptrend. You can't ignore that. That's a clear and cut sign that we're in an uptrend. You're starting to possibly form a cup, and we are yet to form the handle piece of it. So that's bullish. Now, we come across our first boss, as I call it, and that is the 50 weekly moving average, which is sitting perfectly around 499. So next week we expect it to come down to 4055 or 4075 area to coincide with this 4036 area, which we previously was the Powell speech dump down gap up situation. So there's a lot of resistance sitting in this area that we have to see what the price action does. If we are able to conquer this area, I would like to see a back test of it after we interact maybe with the 404 level through an exhaustion rally possibly, where you push up, push through this, go up to here, exhaust. And it's really not important if we conquer this level, it's in the manner that we do it. If we come up to it and then get rejected down to 394 where the 200 daily is, and then run up, break in, keep going higher to the 410 level, that is where I'm gonna go from being more bear skewed in the market to being bullish in the market. The bulls will cheer that. They'll continue saying, we continue to buy the dip no matter what. You're gonna continue to buy because it's lower than you were before. But until that happens, you're in no man's land. This right here is no man's land. So for me, it's pretty cut and clear. If you're able to get over the 50 weekly, it's bullish. If you reject off of it, we got some more work to do, depending on what you form. So now, for the bull scenario, all you got to do is conquer this, conquer 410, which was our CPI Powell tops, and then you're pretty much clear skies to 416, which is the official start of the bull market, which is 20% off the lows. And if we do that, then there's pretty much only, you got gaps that you can fill here that you're gonna probably blow through, and then you're probably going to 425 or 427 area. This is where I would be cautious because this blue line that I have up here is 434. So if we look in hindsight, bear market rallies are notorious for being 25%, rip everyone's face off, everyone thinks the new bull market's here, and wouldn't it be more perfect to trap everyone thinking it's new bull market, send it up here, kind of exhaust down, and then cramp through all levels. Now, if you get up here, I don't foresee that happening because you'll build a lot of support up here, but it's something to be aware of. Now, flipping to the bear side. So if you were a bear this week, and like Mike Tyson would say, everyone's got a plan until they get punched in the face. And the bears got punched 1, 2, 3, 4 times this week, myself included. I got punched down on the bears position that I had, and I made money on the bears position that I had. So, you make money, you lose money. If I was a bear, I'd be looking to short the 50 weekly moving average, overshoot. You're gonna see price come up above this area. You're gonna pierce above it, and I would probably put my sell order right around here to catch the push up and then have my stop loss slightly above. Make sure you guys have your stop losses in place. Just because it went up there, it doesn't necessarily mean that you can't get stopped out. You put in your stop order after you see how price action is moving, and then you have your reaction to it. So once you do that, then you probably have to see what price action does once we come down to 394 and the 390 level. I would be looking to see if you bounce there. If we break straight through, then continue to hold your short position. But I would not be looking to try to catch the top or short it all the way to the crash leg. If you think this is the crash leg, I come in, take my profits, go. If I get stopped out, I get stopped out. I wouldn't try to keep short here, oh, I got stopped out, short here, I got stopped out, short here. That's how bear market squeezes happen. It's natural. So don't revenge trade, but also look at what the chart's telling you. If we break above here and hold 2 candle closes above it, bear situation is gone, guys. Stop being bearish on the market. It's at that point you're a cautious bull, but you gotta stop being bearish on the market. Now, we could be forming what's known as head and shoulders, which you would have left shoulder, head, right shoulder. So there is a bearish pattern here forming, and then we would break it, probably form here, come down 385, which is important because that'll be the top of where we consolidated. And if we break through that, we're heading low. So you got to be cautious of what the chart's telling you. I always say, have the chart tell you what it's doing rather than you try to embody the chart. Today, we saw a massive gap down, push up, hold the top. So let's see what price action next week does. We have a couple catalysts that we're going to discuss in a moment, but let's also look at tech. You have now 2 closes above both the daily 50 and the weekly 200. Your next resistance point is probably 288. That's going to be the head of the possible head and shoulders that you're forming here. So if you break through that and validate the pattern, you could be seeing a resistance point at 294. I don't think that would hit because S&P would significantly be above its 50 simple moving average on the weekly, and tech would then rally through these areas and find minimal resistance. I could be wrong, but we also have this gap up here once we get through these SMAs that we could rally into and possibly go higher. I'm on the bearish side just because we haven't confirmed a bull market. You haven't gone over the first boss even. And there's several things coming in the future that we're about to discuss that could end the bull market or create the next bull market. So let's get into that. If we look at our summary of economic events coming, we have a holiday, so no trading. Nothing really besides Williams. This is the first time FOMC member Williams is going to be speaking post FOMC conference, which the FOMC members haven't really been moving the markets really much, but we have core PPI, which PPI kind of tells us what CPI is going to do. So this is going to be a very watch key event. They're expecting a 0.8 drop. This would kind of tell me if CPI next month will be lower. If we see a 0.8 drop here, then there's a real chance that CPI is going to come in even lower next month. Now, if we start seeing inflation stall out for producers and maybe possibly go higher, that's going to be a warning sign for next time we see CPI, and it's going to be in the back of my head. So I'm going to be receptive of what this says and not try to draw my own conclusions. Next, we have Logan speaking on the same day, so maybe we get some reminding of what CPI means in this. I don't really see that moving the market too much, and nothing really on Wednesday except for Leonard Brainer, the Vice President and Chair of the Reserve. This is the number 2 of the Fed. She is more dovish than hawkish. So if you have a dove that is the second in the Federal Reserve, a voting member, coming out and telling you, hey, longer for higher, possibly, be receptive to that, because she could be what Jerome Powell needed to be to get the bear scenario. Now, if she says 5% stop there and minimal 25% base leg, the market is probably going to rally off of that because it's going to kind of give them what they want. And a 5% rate for longer, they may skew it in a different way. So let's see what she says and let's be receptive to what she says. And then we have Williams speaking again. I really don't see that moving the market. So we head into the following week, which we have GDP the rest of the week. That's going to be a really big print on the 26th because that will tell us if the Fed can actually continue to raise rates. If you're the Federal Reserve and you want to raise rates, you want to raise it into positive GDP. They're expecting 2.5, which is a shrinking GDP, but it's still positive. So you're raising into a healthy economy. And this may incentivize the Fed to get there sooner rather than later if they think GDP is not going to come in. So this is going to be a really important number when they're going into the FOMC meeting, because if they see a significant miss on GDP, you're pretty much possibly going to get a 75 basis point jump due to they need to front load all that interest rate because you don't want to be raising into negative GDP. So then that later you can cut. So then you have the core PCE. This is what the Federal Reserve looks at. This is what they're using to determine their future rate hike. So 5.5 and 4.6 was the previous month's release. So for December, let's see what we get for the overalls and the 0.2 increase in core PCE month to month. So they think it's going to be flat. So we could possibly see 4.7, 4.5 maybe just off that objective. And let's see what this comes in, because that is crucial for the summary of economic projections. This is what the Federal Reserve uses to decide what they're going to do. They don't care what the market says. They're going to look at these numbers. If these numbers are being targeted, they're going to stop raising rates. So let's look at it from an objective point. 3.8 to 4.1 for 2023 June. You're at 3.5. You got a little ways to go. So yes, we can get there, but you have to get here by March. Because if this number gets revised higher in their March release of summary of economic projections to, let's say, 4.2 as the bottom, you're not going to be in a good spot. On top of, you're nowhere near their 2022 target. You're 3.5 right now, and their 3.8 that they got in the previous meeting that kind of gave them a way out of not hiking harder is now 3.7. You're not hitting target in 2022. They thought their target for 2022 was 3.8 minimum. So if we go to core inflation for core PCE, you're not a target either. You're slightly above PCE target, which is hopeful that it's going to come down, and that's going to be a really, really key print for the Federal Reserve going into the FOMC on February 1st. That's the last data point they're going to get, and that's pretty much going to determine their forward projection of what they're going to do. If they start seeing that this is on a downward trajectory, going towards their target for June of 2.5 to 3.2 or 3 to 3.4 by the end of 2023, they're gonna be kind to the market. Now, GDP, they see a crunch in 2023, so this is gonna be really key with GDP. GDP and core PCE is the two data points that we have to be on the lookout, because that will determine, it'll be recency bias for the Fed. They're gonna be looking at those two numbers, and that will really drive their decision making and really determine their path forward. Let's be receptive with what the numbers are telling us. Put yourself in a Fed chair's shoes. If you think they're gonna continue to be more aggressive, you got more pain ahead. And the market can, proverbially, they say, don't fight the Fed. The market's pretty much fighting the Fed. You have Fed chairs coming out telling them the same thing, driving into their heads. The market ain't listening. So there's a discrepancy there on top of the market's pricing in cuts. You have had no Fed chair support cutting rates in 2023. So when that reprices, it can be ugly for the market, or it could be a big nothing burger. So moral of the story is, no side's winning. You have more downside potential, in my opinion, than upside potential. And let's see what the data says. I'm not going to try to have these charts and the data forced upon me. I'm going to listen to what the data is saying, listen to what the chart's saying, and plan accordingly. Right now, I'm going to be in a risk-off environment where for the next 2 weeks, I'm pretty much going to be maybe scalp trading here and there because we're around these key levels. And if I see an opportunity, I'll go in it. I'm going to be more bear skewed than bull skewed. But if there's a bullish opportunity that comes across, I'm still going to take it. We're in the business of making money. So what I leave you with is, this is your guide right here to what the Federal Reserve is going to do. If these numbers aren't getting hit, they're going higher for longer and more pain. If these numbers are getting hit, hunky-doriness. So with that, if you guys like that, drop a like down below, throw a comment what you think, if this was informational. And if you guys want to see more of this, put that in the comment section, hit subscribe. And with that, I bid you adieu. Have a great day.